Hello everyone, welcome back to this week's Technical Insights. Global equity markets ended the first full trading week of 2025 on a negative note. On Friday, we saw the latest US non-farm payroll numbers that showed that US payroll grew by 256,000 in December, while the market expected only an increase of 155,000. The unemployment rate, which was projected to remain at 4.2%, meanwhile fell to 4.1% for the month. These red-hot job reports caused the yield on a 10-year US Treasury note to spike to the highest level since 2023. Although this is good news for the US economy, it may not be good news for investors or the markets. After the report was out, the Dow Jones Industrial Average dropped 696 points or 1.63% to close at 41,938 points. The S&P 500 slipped 91 points or 1.54% to end at 5,827 points. Tech-heavy Nasdaq Composite Index also fell 317 points or 1.63% to close at 19,161 points. This unexpected jump in the payroll numbers dampened investors' expectation for more interest rate cuts this year and caused the market to unwind some of the expectation earlier. However, that does not change analysts' expectation that the US labor market is likely to decelerate further in the second half of the year or even in the coming quarters. For the trading week, the 30-stock Dow Jones Index dropped 1.86%. The S&P 500 index also lost 1.94%. The Nasdaq Composite Index was the worst performer, dropping 2.34%, and all three indices closed their second consecutive week in the red. Market now see a 97% chance that the Fed will leave the interest rate unchanged at the meeting later this month. And we now think that the US Central Bank will also hold the rates where they are now in the March meeting as well, based on Fed Fund futures pricing, and odds of a March rate cuts fell to just 25%. Having said that, the important thing is why are rates moving higher? It's because US economy is doing well and better than expected. That means we may see potential better earnings ahead and less risk of a recession. And this is what is really going to dictate the long-term returns versus the sell-off that we saw on Friday. In Asia, Hong Kong stocks ended low on Friday, extending the losing streak to a fifth consecutive session, as sentiment was dampened by growing apprehension over the potential impacts of new tariffs under the incoming US administration. The Hang Seng Index retreated 176 points or 0.92% on Friday to end the week at 19,064 points. The Hang Seng Tech Index declined 1.18% or 50 points to close at 4,260 points. For the trading week, the Hang Seng Index fell a massive 3.52%, while the Hang Seng Index also tanked 3.23%. For the first half of the year, the Chinese and Hong Kong markets are likely to be more volatile as the US and China bilateral tensions are expected to escalate shortly after the new Trump administration take office. Combining this with the Chinese property sector troubles, the recent weak Chinese economic data, Chinese market are expected to remain weak in the short term. The key question in 2025 for the Chinese market is how much stimulus policymakers will provide, and this will largely depend on the impacts from the tariffs, and policymakers are likely to do just enough to achieve the set GDP growth target for this year. Back to Singapore, our STI index was down 61 points or 1.58% to close Friday at 3,801 points. On Thursday, we also saw a smaller drop of 0.63%, and this 2 days decline came after the 1.54% jump that we saw on Wednesday that propelled STI to a 17-year high of 3,887 points. For the trading week, the STI is almost flat, down just 0.27 points or just 0.01%, and this is the first negative week that we see in 3. On the big movers of the STI on last Friday, we see Yangtze Shipbuilding and Sembcorp both lower by more than 3%. There weren't many developments or news last few days for their pullback. In fact, Yangtze Shipbuilding had their target price raised by CGS International last week to $3.62 from $3.20, as their earnings are likely to benefit from the Chinese yuan depreciation. So I'll attribute the pullbacks of these 2 days to profit taking as the STI hit a 17-year high on Wednesday. On our 3 local banks, they are down around 2% on Friday, but for the trading week, they are still positive, with OCBC leading the pack up 3.2% for the trading period. DBS also hit an all-time high of $45.44 on Wednesday, and that was due to better than expected US ISM service PMI data. That day, that then projected or points to fewer interest rate cuts this year, meaning that rates are likely to remain elevated, hence further benefiting our local banks' net interest margin further. So for this quick analysis, let's look at DBS. Last Friday, DBS share price dropped by 87 cents or 1.93% to close at $44.13. For the week, the share price is still up about 1.17% for a third consecutive winning week after the previous week gain of 0.16%. From the chart, we note that DBS share price has been on a very strong uptrend for the year of 2024, benefiting from the elevated interest rate, enhancing their net interest margin. DBS previous high was seen on the 5th of December over here, where it hit a high of $44.95. And we have since breached that level last Wednesday as we hit a new all-time high of $45.44. We also noted that the pullback of DBS share price last Friday has brought it back closer to the 20 days moving average, which is the white line that you see here on the Bollinger Band basis, now at $43.89. And this could be the first support level for DBS Bank share price. Below the 20 days moving average, the next support level can be seen at the previous low that we saw for DBS share price on the 23rd of December over here at $42.72. And this now has found confluence with the lower bound of the Bollinger Band at $42.73, providing further support for DBS share price at this level. On the indicators, MACD is showing a slight positive reading, and the MACD line is observed to be converging towards the signal line, indicating that there's a very weak uptrend momentum. The RSI reading at 54 is also just 4 points above the 50-point neutral mark, indicating a very weak uptrend momentum as well. So with both the MACD and the RSI signaling weak uptrend momentum, investors can be patient to accumulate DBS Bank share price around the 20 days moving average and the 50 days moving average at $43.89 and $42.72 respectively. Based on 17 analysts covering DBS in the past 3 months, 41% of them had a strong buy call, 17 had a buy call, and the other 41% had a hold call. There were no sell recommendation, and the average DBS stock price target is $45.72 with a maximum estimate of $50.30 and a minimum estimate of $41.60. So these are the levels for your reference and the updates I have for you this week. So I hope you find the information useful. So do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you next week in the next Technical Insights.